So let us start by first allowing me to introduce our esteemed panel. I'll start to my immediate right with Jim Litinsky, who is the managing member and founder of DHL Capital Group. Just in a little of his background. JHL, thank you. Capital Group. Prior to founding JHL, he was a member of the Drawbridge Special Opportunities Fund at Fortress Investment Group, where he looked across various capital structure levels, including loans, distressed debt, equities, and derivatives. Prior to Fortress, he worked at Omnicom Group and the Allen Company in various senior corporate finance and strategy roles. He has a BA in economics from Yale and a joint JD MBA from Northwestern School of Law and Kellogg, and he is also our only lawyer, I think, on the panel. To his right, we have Charles Bobrinskoy, who is the Director of Research at Ariel Investments. Charlie oversees the firm's investment team and trading operations, as well as all of Ariel Investments' proprietary research. He's also the co-portfolio manager of the Ariel Focus Fund, a concentrated portfolio investing in mid to large cap companies. Additionally, Charlie is a member of Ariel's board of directors. He has a degree in economics from Duke and an MBA from the University of Chicago. And finally, but not least, we have Barry Colvin, who's the vice chairman at Balyasny Asset Management, and he's also a member of their executive committee. He joined Balyasny in 2006 and has been focused on building the firm's institutional capabilities globally. Prior to working at Balyasny, he spent 7 years at Tremont Capital Management, where he was president and CIO. And prior to that, he served as head of alternatives and director of research at the institutional advisory firm Asset Consulting Group, and he holds a degree in economics from the University of Missouri. And without further ado, you know, this panel's focus is sort of on leadership and your views on leadership. And I'd like to start us off by talking about, you know, where you think some of the current challenges and opportunities are. And Jim, if I could, I'll start with you. You know, over the last 18 months, how has your firm's approach to the marketplace changed?
Sure. Let's see, last 18 months. Well, good morning, everyone. I would say, so going back 18 months ago, we were, you know, basically on the verge of a deflationary collapse in both in the U.S. and in the global markets. And I think we were, in early '08, we were sort of witnessing two sort of counter phenomenon. You were seeing financial institutions, broker-dealers, and banks collapsing, and you were seeing the global decoupling thesis playing out, commodities markets spiking, and then that obviously sort of culminated in the summer and fall of 2008 with the collapse of Lehman, which, you know, sent a shockwave through the markets and effectively was a major transitional event. And I think that was sort of the transitional event, at least from our outlook, that ushered in an era of, you know, surviving in an era of wealth destruction to surviving in an era of government intervention. You know, the events of Lehman, and then with the Fed, you know, the Fed did a pretty remarkable job actually, you know, keeping the wheels on the wagon and making sure that what we witnessed in the markets didn't collapse into anything worse. But I think what those events also did is we now have a more activist government, and so I think to navigate the environment, you know, we have interest rates at zero, and I think we've seen sort of since March of 2009 to today, the equity markets and credit markets especially have aggressively rallied back, and you know, it's pretty unbelievable just if you look at the research coming out of Wall Street or just the general sentiment of how excited people are, again, taking risk. And the reality of it is that, you know, stocks are probably sort of the least bad in a world where governments are likely soon to face some type of rebalancing issue, whether it's, you know, adjustments that they make themselves or adjustments that are forced upon them. But, you know, that being said, there is sort of a behavioral element to it, and things, you know, you have to be mindful of. You have to navigate these markets, but you also have to be aware that, you know, the psychology can change very quickly. And so, you know, I think that's sort of the dynamic, the backdrop of how we see the environment.
Charlie or Barry, care to comment? The last 18 months?
Well, I think I'll start. We've gone, 18 months ago, we were in a market in which you wanted to sell everything that was going down, and you wanted to not be an independent thinker. The worst thing in the world you could do 18 months ago was to try to buy what was out of favor, because if it went down yesterday, it was going to go down tomorrow. And we tried to be contrarians, and 2008 was the worst market to be a contrarian, really, I think, in the last 40 years. We tried to buy things on a value basis that were cheap, and they just kept getting cheaper. And it was the most frustrating time in my investment career. I've been in the business for about 30 years, and there's never been a time when fundamentals mattered less. And then all of a sudden, like a switch on March 9th, that just changed completely. And all of a sudden, buying what had gone down last year started working. And buying stuff that was really cheap started working. And it worked better than it's worked in 50 years. I mean, you can, probably there are people in this room that know momentum better than I do, but 2009 was the worst year for momentum investing since the Great Depression. If you bought what had not worked the year before, you did spectacularly well. And so it was the best year in Ariel's history. I mean, all of a sudden, being a contrarian was wonderful again. And so our Ariel fund was up 170% from March 9th through March 9th the following year after a horrific 2008. So, you know, of course, the challenge is, going forward, can you take this kind of volatility that we took? But it's just, the summary would be, we went from a world in which value didn't matter to a world in which value was the only thing that mattered.
Mm-hmm. Barry? Nope. Okay. Well, you know, during the same time, we do hear a lot about, you know, consolidation and retrenchment. And Barry, I'm wondering, in your perspective, as you look to, you know, expand your operation and footprint globally, do you find that that's, you know, only happening here, or is it really a global phenomenon, and are we coming out of that, perhaps?
Yeah, you know, it's interesting. Seems like during every environment, the cycle is that firms go through, and the steps that they take are very similar. During expansion times, people open new offices, they get into strategies that are unfamiliar to them, but look interesting, and they grow the business. And then during very difficult times, they realize that they need to close some offices that were too remote and shut down strategies they really didn't understand in the first place. And then it looks like now, if you read some of the headlines in the local industry rags, that's reversing again. You know, people are now interested in opening different offices. They're looking at adding strategies and areas. The cycle, to me, is, and we can talk about this in terms of asset allocation, but the cycle of that has shortened so much, even in the last 10, 15 years. It used to be that they would learn from those mistakes for at least a couple more years, right? And then decide that, oh, I don't know anything about that strategy, but it doesn't mean I can't go into it, or open offices. So the interesting part is that I think those firms, well, I know those firms that have either held to what they know the best, with your quant, stay quant, with your fundamental, really stay fundamental, and focus on those markets and in those areas that you know well, and don't be tempted to go off into areas that you don't really know much about. Some firms have learned that lesson and are not doing that. Others were always there and won't change. In my view, they're going to be the most successful. Otherwise, people will be destined to learn the lesson again and again. Mm-hmm. Stick with what you know, and stick where you know.